Hi, I'm Christine Benz from Morningstar.com. Longevity annuities have been getting more attention in recent years. Joining me to discuss how they might fit into a portfolio is financial planning expert Michael Kitces. Michael, thank you so much for being here.
Oh, my pleasure. Thanks for having me back.
These qualified longevity annuity contracts, they've really been in the press over the past year. So let's talk about first what they are and why they have been receiving more attention of late.
So longevity annuity is kind of an interesting beast unto itself. The industry actually has even struggled to figure out what to call these in order to describe them. So the way I actually find is easiest to describe what longevity annuities are is to describe what they're not. So what they're not are immediate annuities. The immediate annuity is that classic annuity transaction that literally goes back hundreds of years. I write a lump sum check to an insurance company or a provider. In exchange, they give me checks for life. So in today's marketplace, a 65-year-old married couple could write a check for about $100,000, and they would get checks for life of about $500 a month for however long it is that they live. I write the check now, I start getting the monthly checks in return immediately. So longevity annuities take that same kind of trade-off. I'm going to write a $100,000 check now in exchange for payments for life. But instead of having the payments in return begin immediately, they're not going to start until later. They're deferred. So a classic longevity annuity transaction might say, I'm going to write a $100,000 check now as a 65-year-old couple. I'm not going to get any checks until I turn 85. But when I do, because I put a 20-year waiting period in there, the checks are huge. In today's marketplace, we find they're about $2,600 a month. That's more than $30,000 a year. So kind of this very magnified outcome. I write a $100,000 check now. I get a payout rate of 30%. But I got to wait 20 years just to get my first check. And so then we get this very magnified effect on the back end. I got to live 20 years to get my first check, but then I only have to live 3 more years to recover pretty much all my principal at $30,000+ a year. Then I have to live 3 more years to double my money, 3 more years to triple my money, 3 more years to quadruple my money, and that just kind of grows exponentially from there. So that's the nature of a longevity annuity. And this sort of magnified outcome, I don't get any growth up front, but I get huge growth in the back end, is from the research perspective, an amazingly efficient way to solve the retirement income puzzle, because not to be morbid, but if I pass away in the first 10 or 20 years, I probably don't have a retirement income shortfall. If I live well into my 90s, I'm at a significant risk for a retirement income shortfall because that's just a long time to fund retirement. So that's a fantastic time to have an investment that's paying me out 200%, 300%, 400% upside in the later years.
So in terms of how these products have gotten into the news, the reason that they are getting more attention is that they are now a permissible option within certain types of retirement plans.
Right. So longevity annuities originated as just a standard form of annuity. I could buy an immediate annuity where the payments begin now, or I could buy this longevity annuity version where the payments begin later. Some companies in the industry call these deferred income annuities to kind of recognize that I'm going to get income on monthly payments, but it's going to be deferred until the future. Now, for people that just wanted to buy that with kind of dollars from a checking account, a savings account, or investment account, that was pretty straightforward. Write your check, get your terms, payments will begin in the future. That created a problem in retirement accounts, though, because, of course, with retirement accounts, Uncle Sam wants a share and says, well, I don't care whether you need the income or not. When you turn 70 and a half, you have to start taking money out, so Uncle Sam gets a slice. We call those the required minimum distributions. So we had this conflict. Some retirees wanted to buy longevity annuities because they just wanted the payouts in the later years with that, big return in your 90s. And they wanted to buy it in their retirement accounts because that's where many of us keep our retirement savings. But we had this conflict. I want to buy it in my retirement accounts, but the checks won't begin until 85, but the IRS says I need to take money out when I'm 70 and a half, and how do I get the money out when I'm not getting any checks until I'm 85? So about a year and a half ago, almost 2 years ago now, the IRS and Treasury created these new rules for what are called qualified longevity annuity contracts, QLAC or QLACs for short. And the QLAC rules simply say you're allowed to buy a longevity annuity inside of a retirement account and not get in trouble with the RMD rules, even though you don't get your first check until age 85. And we simply limit the dollar amounts. You can't do more than $125,000 a year of total dollars or 25% of your account balances, whichever is less. So we're a little bit limited on retirement accounts, but we can do it with retirement account dollars, or you can buy as much of this as you want with taxable account dollars.
Okay, so payouts, as you indicated, can be pretty attractive. Let's talk about how they stack up relative to other asset classes. So if the person is sort of looking at their account and saying, well, I could deploy my money in any number of ways, how do they make this comparison about whether the money is best deployed into one of these longevity annuities?
Good question. So longevity annuities they suffer from this thing I called the compared to what problem, which is whether you think these are a good or a bad deal really depends on what you would have been using as an investment instead. So against some alternatives, they just clearly lose. The number one version of a longevity annuity is simply delaying Social Security until age 70. And in fact, it really never makes sense to buy one of these until you've delayed Social Security until age 70 first. Delaying Social Security is kind of like a longevity annuity. It just is priced based on 1983 interest rates and mortality tables because that was the last time we changed the Social Security system. And those are really good payout rates by today's environment. Now, at the other end of the spectrum, we compare this to something like a bond investment. This gets really powerful. Now, most people can't really intuitively do the math. So if I get a 30% payout rate, but I have to wait 20 years to get it, is that actually a good deal or not? What's the value of a 30% payout rate that doesn't start for decades? When we actually run the math on this, and we've done some analysis and published some research on this, what we find is that the payout rates on these longevity annuities, if you do really well, so you live to 100. If you make it out to 100, your payout rate is about 5 to 6%. In other words, you would have had to buy bonds that paid you 5 or 6% over the next 30 plus years to get an equivalent of a longevity annuity payout. Now, when we look at interest rates today, 5 or 6% is actually a pretty good return,
Absolutely.
Very compelling. So if you're using this as a fixed income substitute, longevity annuities actually look really good. When we compare it to equities, though, unfortunately not quite so good. When we look at long-term returns on equities, it's closer to 10%, even when we kind of haircut the returns a little bit for maybe being in a high valuation environment over 30 plus years. Even high valuation doesn't take that much off 30-year returns. And when we compound up for 30 years, we find good old equities still look better than where annuities are right now. So we can kind of do this hierarchy. Delaying Social Security is best. Then equities look good, then longevity annuities are behind that, and then bonds are way down behind longevity annuities in the long run. And so that's how we look at stacking them up right now. Now, the interesting effect, of course, is all of these are dynamic. Interest rates change over time, so bonds may look a little different at some point. Because longevity annuities, insurance companies fund them heavily with bonds. That's how the insurance company makes sure they'll have the money to pay you when the time comes. They're actually sensitive to interest rates as well, which means if interest rates go up, bonds will get more compelling. But if interest rates go up, longevity annuities will get more compelling as well. We actually think there's some possibility that if rates rise enough, longevity annuities will actually be competitive with equities head to head, and that the future of retirement might be a blend of equities and longevity annuities. Even arguably right now, we can make the case for a blend of equities, bonds, and longevity annuities, where the longevity annuities come out of the bond portion. All just trying to put together this sort of combination picture of how do we deal with the risk of inflation, the risk of equity volatility and sequence of return risk, and the danger that we just live a really long time and don't have enough money to fit that whole time horizon.
You think that increased competition in this space could actually be ultimately beneficial for would-be buyers? Yeah,
I've written about this a couple of times, that I think ultimately a little more competition in this space probably would be good as well. The reality right now is, even when we look at the annuity landscape overall, there's been a lot of discussion that longevity annuities have been the fastest growing annuity product. Sales in 2015 were up, I think, 50+% over where they'd been in prior years. But that was from a very small base. Overall, longevity annuities are less than 1% of all annuity sales. And of course, annuities are only a small fraction of the total retirement marketplace. So unfortunately, there's just not a lot of pricing competition really there yet. And so, I think we'll see some counterbalancing factors in the coming years. Competition where annuity companies want to win the business, so they offer to pay out a little bit more, could lift payout rates a little bit. Rising interest rates could lift payout rates a little bit. Although, ironically, if we keep getting healthier as we make more and more medical breakthroughs, that could actually bring the payout rates down because, of course, the annuity companies need to hedge against the possibility that we all live to 100.
Right.
They're meant to ensure the fact that a few of us might live to 100, not all of us living to 100. So there are a lot of forces hitting longevity annuities from all directions that we'll see how it plays out on whether the payout rates really get better or how much better they get. But certainly for what we see today, much better than bonds for long-term retirees trying to hedge against the possibility they live into their 90s or 100. Not terribly compelling to equities yet, although not horribly far behind either. And still can't hold a candle to Social Security and delaying Social Security for where it stands right now.
So the profile for whom such a product would be especially appropriate, person needs to have longevity on their side. They should have already looked at the Social Security maximization and delaying Social Security. Any other factors?
Yeah, so the driving scenarios that we see, so you got to be optimistic about your health overall. Now, of course, and ironically, this actually brings longevity annuity payout rates down a little bit because the insurance companies have long since figured out the people who pick these tend not to merely be of average health. They tend to be pretty healthy. But on the flip side, that means you really probably don't want to buy one at this point unless you're part of that very healthy pool that's got maybe family genetics on your side and you're concerned that you're going to live into your 90s or 100. So good family genetics and health on your side, concerned about living out to 100 and that you might not have enough money to get there, have already delayed Social Security until age 70 and are looking at more ways to kind of hedge against this possibility. And I think certainly for today's marketplace and have some fixed income that you can carve this out of. Again, it's a little bit difficult to make the case for this over equities right now, but it's very easy to make the case for it over fixed income. And so if only to view it as a fixed income diversifier, it looks really compelling to say, well, maybe we should take a little bit out of the bond allocation and put it over towards this longevity annuity instead. If something happens over the next 10 or 20 years, we don't want to end up having the money and using it. But if we live for a long time, we've got this really nice payout that looks much better than bond rates today, should we happen to go that long. And basically, we manage our risk to the allocation by just not putting very much into it. And I know David Blanchett here at Morningstar as well has published a bit on this and found optimal allocations to longevity annuities might only be 10, 15% of someone's total retirement portfolio. So we're not going to put a huge amount of money in. We're just going to put a portion in to cover those later years in a manner that looks much better than bonds and maybe even someday competitive with stocks.
Okay, Michael, interesting product type. Thank you so much for being here to share your insights.
My pleasure. I hope it helps.